My next guest agrees that there's going to be a pause at next week's meeting. She is not stopping there, saying the Fed could be done with hikes altogether thanks to the slowing labor market and progress on inflation. Joining me now is Julia Coronado, founder of Macro Policy Perspectives, along with Margie Patel, senior portfolio manager at Allspring Global Investments. Welcome to both of you. Julia, it sure seems like with the strength of that job number, with the strength of the inflation reading at core, like there would be reason to raise from here, but you say no?
Yeah, I mean, look, let's take a look at that job report under the hood a little bit. So the job number was very strong, but the unemployment rate also jumped 0.3, which is an unusually large upward move in the unemployment rate. When we look at the discrepancy between these two readings, what we see is falling self-employment. We see a falling work week, so aggregate hours worked, which is the labor market measure that feeds into GDP, is slowing a lot faster than jobs. So there is more indications of slowing in the labor market than just that headline payroll number suggests. Wage growth is moderating. And we do think that things like used car prices, which temporarily put some upward pressure on core inflation in the last 2 months, is going to turn around and go deeply negative in the next few months. So we think the Fed is about to see a string of inflation readings that are going to give it a lot more comfort that its policy is starting to have an effect.
Okay, but Margie, it seems to me like the Fed's been about to see a string of such good news for a long time, but the surprise to me has been how little things are slowing down relative to what one might expect. Okay, these 75 basis point hikes eventually are going to catch up to us and we're going to feel them, or that regional bank stress is going to cause a break, right, on credit availability. And we're hearing from overseas, yeah, maybe not so much.
Mm-hmm. Well, that's right. I think it shows you there is, if not a disconnect, not a close relationship between what the Fed has done and what the economy has done. We had a record increase in short rates over the shortest period of time, 5% in 1 year, and yet the economy is really in pretty good shape. Consumers in good shape. The labor market looks not bad. And here and there, we're seeing signs that inflation is certainly not accelerating. It's actually tapering off. So the Fed, I think, is probably a little flummoxed because whatever formula it had for raising rates by this much, we have this much response in the market in terms of inflation and growth, just doesn't happen. The good news is the economy is very strong in spite of what the Fed has done. So we hope the Fed will take their foot off the brake and stop raising rates and stop damaging the economy and let the economy grow, which is what we think will happen.
Okay, so Julia, what is the fixed income strategy here, aside from buying high-quality bonds? Because, yes, we've heard that before, but what should the fixed income investor do here that she or he is going to feel really smart about 3 years from now?
Well, I think like you were just outlining in terms of the repricing of Fed policy, I think that's going in the right direction. What the Fed is trying to do here is find the rate it can hold at. That's what a soft landing is not the Fed turning around and cutting very quickly. It's finding that rate that's going to gradually put downward pressure on inflation and keep the economy on an even keel. I think we're getting close to that rate. There may be another hike. I think there's risks to that, but we're not far from that. But it does mean higher for longer. It doesn't mean a quick Fed pivot. I think the playbook from last cycle of the Fed reacting to every weakness with a rate cut is not going to come forward this cycle. So what were the areas that benefited lower for longer? I think right now we still see some richness in credit spreads. There's going to be pain in companies that are going to have to show profits. They're going to have to show real returns. It's not going to be a lot of financial engineering at their fingertips the way there was last cycle. So there's going to be businesses that are in the real economy delivering real returns are the ones that I think are going to benefit in this higher rate environment.
And cash probably not going to be trash again for a very, very long time. Julia, Margie, thank you.